The first name in Dividend Kings in Canada belongs to Canadian Utilities, and they may be top of the mountain, but can they keep that title? Fasten your seatbelts, folks. This is going to be a good one. A Dividend King is a company that has increased their dividend for 50 consecutive years, and at the time of recording, only Canadian Utilities has done this with a 51-year streak. In December of this year, Fortis will hit that 50-year mark, and they will be joining them at the top of the heap. However, we do have to wonder if Canadian Utilities has the fundamentals to stay there. Another name that does enter the picture when you are talking about Canadian Utilities is ATCO. Canadian Utilities is a principal subsidiary of ATCO Limited. So what is that all about? CU has deep roots in Alberta's utility sector, going all the way back to the late 1920s. Over the decades, Canadian Utilities has played a pivotal role in growing Canada's growth, expanding its operations to include electricity generation, natural gas, and of course electricity distribution. They also added a presence in international markets such as Australia, Mexico, and South America. Recognized as one of Canada's most expansive utilities enterprises, Canadian Utilities' dedication to sustainable development, technological advancement, and community involvement has solidified its position as an industry leader. Of course, being a Dividend King is just the cherry on the top. When we look at ATCO, they actually began their journey back in Alberta as well, 1947. They started as Alberta Trailer Hire Company, and they used to focus initially on trailer rentals and modular housing. Of course, over the years, ATCO embarked on a path of diversification and growth, and they eventually ventured into the utility sector among, well, other areas, of course. In the 1980s, ATCO's strategic acquisition of Canadian Utilities bolstered its footprint in the utilities domain. Of course, this acquisition was actually pretty easy, as both companies were formed by the two same guys. So under ATCO's leadership, CU has flourished, continuing its legacy of service excellence and innovative contributions to the utility sector. As a side note, ATCO has only raised its dividend for 29 consecutive years. Join the conversation. Let us know in the comments if you hold any shares of Canadian Utilities or maybe ATCO. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. Utilities companies in general have had a rough ride over the bear market, and there is no guarantee that it won't continue as we move into, well, this mild recession, at least a technical one. However, the demand for power is not going to go away, and for the most part, the worst may very well be over for the utility sector. Whether or not we have a recovery in the future for the sector, we are still going to need a chance to curl up with some of the numbers, and if we're going to do that, well, we're going to need to call on our good old buddy, Mr. Math. As usual, we will begin with a wee bit of that surface data. They have a market cap of $8.14 billion, and they've got a pretty stable beta of 0.61. Utility companies in general do tend to favor lower betas. Their earnings per share comes in at 2.18, and they have a price to earnings ratio of 13.50. If we look at a few of their peers, the average in that group comes out at 11.0. When we do look at their peers, we can see that, well, the parent company ATCO has a PE of 9.6. Northland Power comes in at 11.6, and Brookfield Renewables comes in at 12.7. They have a price to book ratio of 1.50, and their peers, that average there comes in at 1.20. I mean, overall, between these two numbers, they're not very far off, so I don't think we can really say whether or not they're overvalued or undervalued. There's a leaning towards overvalued, but I suspect with how far these companies have been pushed down, we're definitely going to be in undervalued territory. We will finish off this section with that return on equity, and that comes in at 9.68%. The surface data is not bad at all, so let's peel back another layer and take a gander at their cash. They have a revenue of $3.93 billion, and their earnings come in at $589 million. Now, those earnings are projected to grow by 2.98% per year. Their profit margin is actually not that bad at 15%. They have a free cash flow of $485 million, and their operating cash flow, that comes in at $1.88 billion. Looking at their fair value, the current value was $29.34. Using a discounted cash flow model, we get a fair value of $107.45. Holy banana bread. That puts them undervalued at 72.7%. I don't think we're going to see an explosive 72% growth in this company. In fact, the one-year price target is $35.36. So that's a growth that we're expecting to see in the next year of about 20.5%. 4%. Oh yeah, there sure is a potential for some growth, and that does have me a wee bit intrigued for sure. However, for now, let's take a look at their returns. Their dividend comes in at a pretty high yield of 6.116%. That is a quarterly dividend paid out in the amount of 44.9 cents per share. That payout ratio, it's actually not that bad. It's 82.11%. This is a dividend that they are not going to cut lightly, as that would strip them of their dividend king status. Think about that. This is a company that has weathered everything thrown at the market in the last 51 years, and they have risen above it all. I suspect they are not going to fall this time, and they will do whatever it takes to keep the streak alive. Let's take a look at their returns. On the 3-year, their price did drop from $31.20 to $29.29. That is a negative return on investment of negative 6.52%. But after factoring in the dividends, we do come back onto the positive side. We get a total return of 11.64%. If we look at their 1-year, price dropped from $35.29 to $29.29. That is a return on investment of negative 20.48%. We factor in the dividends. It can't save it this time. We do get a negative 14.37%. On the year to date, they have fallen from $36.75 to $29.29. So overall this year, their return on investment is negative 25.47%, and that gives us a total return after we add in some of those dividends of negative 20.87%. These returns reflect easily that most of the pain has been in the last year, and hopefully they are able to level off and start moving back up again. I do think if we revisit this stock next year, we should see some of that recovery, even with those returns not looking so great. I have no judgments yet, as we still have another layer to look at. So without any further ado, let's check out their debt situation. Their total debt, that comes in at $10.57 billion, and their total equity comes in at $6.98 billion. Their debt to equity ratio, that comes in at 151.3%. Now, their debt to equity ratio has come down a wee bit over their last 5 years. It fell from 159.2% to that current 151.3%. Not a huge amount, but at least it is moving in the right direction. As for their cash and cash equivalents, we do have $616 million. Let's switch over to the short term. On the short term, their assets come in at $1.4 billion and their liabilities come in at $1.65 billion. Not perfect, that's for sure. And let's take a look at those long term. On the long term, their assets come in at $21.45 billion, their liabilities at $14.22 billion. Much better. I like to see that a little bit more than what we looked at with the short term. Overall, this is not a great debt picture. It should go without saying, it is not a debt covered by their operating cash flow. The interest on that debt, though, is covered by their EBIT, or earnings before interest and taxes. Still, this is a debt situation that is something we will need to weigh in on when we give our final verdict. So with that being said, I do have to ask, what is my final verdict on Canadian Utilities? Let's start with the dividends. And I will be honest in saying that if they were not a dividend king, I would be unsurprised if they cut the dividend. However, that coveted dividend king title is not one they want to give up, and that makes this dividend much safer than it should be. So for the passive income investor, this is a safer bet if you are looking for their 6.1% yield, and you will get some growth as the company recovers from the recent downturns in the sector. As I said before, their debt is not ideal. However, it is not crushing. And while it is survivable, they are working on it, though with rate hikes and higher interest, it may take longer to get it back to a more respectable level. The overall risk factors for this company are not actually that bad. They look bad, but they're not as bad as they look. There are, of course, the debt concerns, and that dividend is not, of course, covered by their cash flow. However, all indications are that the situation will be improving as we move through the next year. For the short, mid, and long-term investor, there is going to be some growth here, and that can be an opportunity for your portfolio. This is a strong dividend-sided total return stock protected by that dividend king status to maintain, of course, the status quo with the passive income aspect of that total return. I do like this picture overall, but that debt still annoys me a wee bit, but not enough to exclude this stock from a potential future inclusion into the 0 to 100K challenge. If you like this stock, don't just run out and buy it without doing a heaping helping of due diligence before you throw any of your hard-earned money on the table. Keep the learning going. Watch my video on the 0 to 100K challenge linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will of course see you in the next video.